I actually agree with all of what we're probably going to talk about, the sub-twos, the wraps, the contract for deed. My niche was the lease option. That's really where I got my traction. I chased foreclosures for a while, and that was super tough. The lease options are easy. You could buy a pretty home in a nice area and no equity at all and still figure out how to make money. And the seller can understand the concept. It's pretty simple.
All right, Kevin Amolsch, you are a lender, creative finance whiz, investor first, lender second. Thanks for coming on the show, man. Very excited to have you here. And I would love to hear your background and, where you came from and everything that you're working on.
Yeah, no worries. Mike, Dan, thank you so much for having me. I'm super excited. We talked right before you hit record how much I love the name of your podcast. I'm just glad that you let me come on. So appreciate you. Yeah, I got started super young. I was just getting out of the Army. Had a little tiny small savings account, not like you make very much in the military, but I had enough I was thinking like, God, I got to do something with this. So I started reading books and, that purple Bible that we all know about, Rich Dad, Poor Dad. We read that first, and then it was like, okay, everything's saying go to real estate. So I went to real estate, bought my first house. I was just turned 21, rented it out, or I lived there for 2 years, moved out, rented it out. And I realized, gosh, dang, this is going to be the vehicle that's going to make me rich. I just know it. So I've really focused in on it. And here I am in school, working, trying to figure out how to buy houses. And I figured it out. I started buying 1 or 2 houses every month, calling motivated sellers as I was walking between classrooms. And you do that. I didn't have money or credit or any of that. So I really had to figure out how to do that. And it comes down to the creative finance. And like you said, Mike, and as I was going through my career, I just really focused in on the financing side of real estate. That's really where my passion was. And I became a private money lender. So now we have multiple mortgage funds. I'm super proud. I just got my first public fund approved about 18 months ago. And so now we're raising money publicly. Wow. And we're loaning it out to real estate investors. So, I really found what I'm supposed to be doing.
Nice. I love it. I feel like we just did a really quick travel through time there because
I went fast, didn't I?
Yeah, because going from buying your first property. Well, first off, how long ago was that?
2001.
2001. Okay, and then
while you're in college.
While you're in college.
Yeah, I was still in college, and I moved out after 2 years. So I've been 2 decades as a real estate investor, and I've done developments, built townhome projects, developed land, but I had a hotel for a little while. I've kind of done quite a bit.
A little bit of everything.
Yeah, were you getting into creative finance back then too? Because that's before there was like the people on YouTube that were pretending to teach you how to do it, even though they didn't know what the hell they were doing themselves.
It was much, much harder to learn the business. I'd read a few books and I would just go out and do what the book said and fall on my face. And then eventually I got a mentor and it's a two-person team. They kind of helped lift me up and brought me through. But I was doing creative financing way back then because I couldn't get a loan.
Yeah.
I'm always impressed with real estate investing. It's easy to be a real estate investor these days. You literally just go to YouTube. I'm always impressed with people that have been doing it before the YouTube sensation of real estate gurus and stuff, especially if you're doing anything outside of like buying a rental property with 25% down.
I know.
Right. You had to actually go to Barnes and Noble to buy the book.
Yeah. So I guess one of the reasons I'm super excited to have you on, Kevin, is because you have this creative finance experience, but coming at it with the experience as being a lender, right? And I feel like most people out there that teach creative finance or super into creative finance, it's always about how can we do things that are legal enough that if the lender gets upset that we don't get slapped, especially when looking at, sub-twos or wraps or like all these other sort of things that you see out there right now. But you're going to have a whole different perspective. So I guess when you started out doing creative finance, like what exactly did that mean? Were you just doing like seller carries? Were you doing sub-twos? Were you doing like the wraps and all that sort of stuff, or what?
Yeah, it's very interesting because I actually agree with all of what we're probably going to talk about, the sub-twos, the wraps, the contract for deed. My niche was the lease option. That's really where I got my traction. I chased foreclosures for a while, and that was super tough. The lease options are easy. You could buy a pretty home in a nice area and no equity at all and still figure out how to make money. And the seller can understand the concept. It's pretty simple.
So like you were buying on a lease option?
I was buying on a lease option and
very
selling.
cool.
So I was sandwiching myself between the two. Now it's a little bit tougher to do that now, but if you you structure the deal correctly on the front end, you could still exit with your tenant buyer on the back end without ever owning the home at all.
Yeah.
What do you think makes it a little bit tougher to do it nowadays? Is the market conditions, or like what from then till now? I'd love to know what's different.
Yeah, there's quite a bit different. The SAFE Act is a big piece of that because of 2008. Now we have licensing and we have ability to repay, and we have all these different guidelines that's protecting consumers. But really, the big change or the big shift that I saw in the industry was the dry double close basically went away. It's really difficult to find that.
What is
dry
that?
double close? Is
Double
when I'm
close?
going to buy a property from a seller and I'm going to sell it to a buyer on the same day or the same time, but not bring in any funding. My buyer's funding is going to fund both transactions. Title companies don't really do that much anymore. Now I got to bring in flash cash, right? I got to close on my side before I could sell.
I know a guy that calls that gator lending.
Yeah, that's Pace Morby, who's the current creative financing guru out there that Dan and I like to hate on a little bit. But you're right. Normally you see transactional funds and that sort of stuff that come into play now. You can find the A to B, B to C sort of escrow companies, but in certain states it's illegal to do, as you sort of alluded to. And then you have to find like the one attorney that like kind of has a weird office that no one really goes to that's willing to do it like under the table in a lot of places. Right. Yeah. But that makes sense. 2008 changed a lot of things on the investment and purchasing side. So I guess as you went through that, like what did you, build up before things started to get difficult? Like what did your portfolio look like? Because you said you transferred to hard money lending. I guess unless you were raising a fund, you must have built a pretty decent nest egg to transfer over to that, unless you were just brokering or running a fund or something.
Yeah. So let's dig into that transition there. So it started getting very difficult with the way I was structured. I had a lot of loans also, and I had a bunch of lease options and subject twos, and we were getting close to 60. When I say I was getting close to 60 doors. These are all single family homes.
Wow.
And we were leading up to 2008, but a lot of people weren't investing there that time, so they don't know. But 2006 and 2007 were actually the tough years. That's when interest rates were rising, and we were all in adjustable rate interest only loans. That's what everybody was borrowing. So you have interest rates rising, we had rents coming down, and so I started feeling the squeeze 2006 and 2007. And then like I was losing everything. I was trying to negotiate with the banks to take the properties back, the ones that I owned. I was doing everything I could to get rid of my properties that I owned, and so I could continue to make my payments to the lease options. I was not going to default on those. So I went and got a job. I became a bond analyst for a Wall Street company and started analyzing mortgage bonds, and then I got into hard money lending. The reason I got into hard money lending is I had a mentor that gave me one investor. She knew one little private money guy. He had $100,000, and she said, "Why don't you just go out and loan out this guy's money?" So $100,000. So I went to a real estate sales meeting, and I got up in front of the room and said, "I have $100,000 to lend to somebody that's going to do a fix and flip," and got a deal out of that room, and I just brokered it. I charged 4 points origination, 15% interest. I gave 2 points to him. I kept 2 points. He got all the interest. A ridiculous business model. I made $2,000 on that deal
off that one conversation.
Yeah, but I'll tell you, that one $2,000 check that I made on that deal changed everything, because I saw it. This could work. I was going broke. You told me at the beginning of this call to be real candid with you. I was losing everything. And I had to figure out how do I adjust here. I had a big portfolio that was losing value like crazy. Personal guarantees on a bunch of loans, and this is it. This is what worked.
Yeah.
I first of all, I would say I super respect how you said that you weren't going to default on those lease options, because those are people that you genuinely, they're not a bank, right? That could be people's retirement. They're real people where it's just different when you're talking about a bank loan and the processes for that. So I really respect that, because most people would be like, I don't care about those people. I care about my credit over here with the big banks. So that's huge. And I also think it's pretty awesome, like that conversation, because that's how things start, is like with the $2,000 check, and you're like, holy shit, I can make $2,000. I can make money again. I can do these things. So that's had to have been super empowering at that moment. So what ended up happening with all your properties, like when you were going through that process? Like, what did that look like on the back end before we dive into anything else?
So if I can remember correctly, it was about 8, I think, that I owned with loans on them. So on my credit report, Fannie Mae type loans, I lost them all. I did deeds in lieu on the ones that I could. I short sold the ones that would negotiate with me. But remember, this is the very beginning of 2008. The banks weren't in the trouble they were at the end of the year when I was trying to negotiate. So they didn't care about me. So some of them, they just had to, went through the process, and I lost them. Kept all the lease options. As soon as my option terms were coming due, I was on the phone, and I had a bunch of them, right? I had like 40 something of these. So I would be calling and like trying to renegotiate with them. And the ones that were willing to work with me, I redid the deal, lowered my option price, lowered my rent payment. The ones that said no way, they got the property back. I chose not to exercise my option, and they ended up with the property back. So my portfolio went from almost 60 down to about 20. And then I started rebuilding, because now we're getting into 2009, 10. After I worked through all of this, that was the best buying time that we'll ever see.
Yeah, right.
Like, I have to figure out how to buy some of these properties. So started bringing in partners and, to sign on debt. And I started building my portfolio back up.
Nice. That's awesome. I love that.
So
that's like such a great story of overcoming that situation. And I guess what I look at now is that's comparable to a lot of flippers. We know a ton of people that are in this situation that started flipping houses 2019, then 2020 and 2021 started taking off, and they got greedy and they lost their ass this year. Right. In 2022, they're losing huge amounts of money. People are getting properties foreclosed on. And most of the people that I know, they have packed up shop and are done with it. They've filed bankruptcy. They're doing all this sort of bad stuff. And what you were going through there is, it's a very similar situation. I would say is much more difficult at the end of it, but you were able to come out, figure out all the details. And then you said, I'm going to stick with it and keep going, which I think a lot of people did not do after 2008. And a lot of people are not going to do after 2022 either. So that's cool. So I guess that's what led you to start getting, learning how to raise money and getting into the lending game. And I guess going back to what you said before, where you got that $2,000 check and that sort of got you, that lit you up a little bit. Was the original goal with that to start raising money to basically bail people out? Or were you looking at more like traditional loans, or like what was the strategy, I guess?
Yeah, so I was a mortgage broker at that time. That was the easy transition. I don't want to say a transition, but that was an addition to what I was already doing. Look, I was bleeding, so I needed cash flow, and lending is where my passion was. So I became a mortgage broker, again, before SAFE Act. So there was no licensing. It was literally the Wild West. Yeah. So we could just write loans, and it was really easy. But as we got closer to 2008 and through 2008, it became very challenging. So I stopped doing a mortgage brokering for like owner occupied type stuff. And I just focused in on the real estate investor. Now my stories kind of blend here, because there's the real estate investor side and the lending side. I've been lending since 2006, again, to help supplement the cash flow. That first guy was in 2006.
Okay.
And so from there, I realized that this is going to work. It's just going to take some time to build up. So I started teaching classes like, here, let me show you how to fix and flip a house. And so people would show up, and I would show them, well, I could also loan out your money for you, and here's the kind of returns you can get. Totally illegal, by the way. I didn't even know it. And so I got people like investing with me, and I started raising money for me and my mentor. And then her and I started to conflict, because I was raising all the money, I was loaning out all the money, and she was taking a lion's share of it. So we just started getting some friction. And 2008 hit. She's like, peace out. I like teaching real estate. I don't like doing real estate. I want to be in the trenches. So we split, and I started Pine Financial. That was in 2008.
Oh, wow.
Okay.
It's crazy. Losing everything. My daughter was born, started a brand new company all in 2008.
There you go.
I love that you like admitted to like I was doing it illegally, because Mike and I see so many people like they'll post on Facebook hey, I'm raising money for my real estate business. If you have any self-directed IRAs or just money sitting around your grandma's bank account, send it to me. I'm like, oh my God, really? Really?
Yeah.
Jesus.
Yeah, and ever since the Jobs Act, it actually became easier. Before that, it was tough. I mean, it was really illegal.
Yeah.
And they were. But I got. If you wanted me to share a story, I will. But I got invited into the regulator's office. We sat down at the table, and dude had a badge and a gun.
Oh shit!
He's like, dude. He's like, Kevin, you're under investigation.
Oh, Jesus.
Oh, my God. Talk about changing your day.
It's notoriously violent white collar criminals, man. Like, yeah, that's wild.
Yeah.
So that's how you started the business. And then I guess, how has that grown over this, these last few years since 2008, and you're coming out of that, I guess a recovery period. How has your private money business grown? Like, what does that look like at its core? And how does like your love, I guess, for creative financing sort of tile into this? Because that's the real question most people want to know. Yeah,
so we can go back and forth here because they're very different. But so the creative financing side, the subject twos and the wraps and all of that stuff, that's where I started, and that's what helped me understand that my passion is for the financing side. But I found that I could be more profitable and I could build a bigger company and scale by going to the lending side. So even though I still love that piece of the business, I'm really focused on the lending side now. So we went from, brokering private money, 2 points I'd share with them, 2 points I would keep, to I'm paying way too freaking much money. So now I'm going to keep all the points, but I'm going to give you the interest rate to, okay, let me service this loan for you because you don't know what you're doing. I'll collect the payments. If there's a default, I'll handle all of that. So I started making little servicing fees. And then the feedback was, the values started going up. So the feedback is, I can't fund an entire project. So we need to have lower investment entry points. We need to have bigger diversification, because if there's a default, it's a big deal. And we want some liquidity. Private notes aren't liquid. People tell you that, but they're not. If you want to sell a private note, you're going to have to discount it. So that's not liquid to me. So I had 3 problems I needed to solve. So I started my first real estate fund. It was just a Reg D. And I started bringing in, private investors, and I screwed that up. I wasn't charging any management fees, and I bought some software that wasn't working right. So the math was wrong. And so I had to work my way through that. And so I started another fund and started charging management fees, and I could afford good software. And then I maxed out my non-accredited investor limit on that one. So I had to start another fund. And then we decided, this is working. Let's go Reg A. We're going to go public. And so I could actually tell you an interest rate that I could pay you. It's a promissory note, so I could promise a return, and I don't have to worry about accredited versus non-accredited anymore.
I got a question, but first I love what you're saying when you're like, I screwed that up, I screwed this up. Cause like I'm putting myself in your shoes. I'm like, man, how many things have Mike and I screwed up, including everything you're talking about, we've screwed up. And I'm like, I'm so glad you're honest about it, because nobody talks about like how they screw things up. But this is an interesting question for me. Maybe not so much for our audience. What is the difference between Reg A and Reg D?
Yeah, so a Reg D is a private placement. So it's a PPM. Now you have, you guys in your audience probably knows this, but there's different types of Reg Ds. So you could have, because of the Jobs Act, you could actually advertise a Reg D now, which was never the case before. But you have to only advertise to accredited investors, and you can only accept accredited investors. So that's like the 506C. That's not really important to know, but it's the type of offering. All a Reg A or Reg D is an exemption from a licensing requirement. So you're exempt from licensing because you're notifying the SEC and the states of what you're doing, basically. Now, you can't, with the exception of 506C, which is accredited investors only, you can't advertise for this. It has to be through your private network.
Sure.
Reg A, now we're going public. So we could actually literally be listed on an exchange if you chose to go that route. You could market. I could put up a billboard. I could pay you 8% return. There's no restrictions on accredited versus non-accredited. So it falls more into like almost like a bank. Like they could advertise their CDs that they're paying. So it falls in more to that category. But because of that benefit or privilege, it's highly regulated. So we have twice a year reporting. We have fully audited financials. It was a freaking bitch to get through the process with the SEC.
I bet. Yeah. And that's what you're talking about. 506C, Reg D, Reg A. These are SEC, Securities and Exchange Commission regulations. And what I'm understanding when you say like Reg D, like an exemption saying, hey, this is an exemption. If you follow these rules, you don't have to go and do this whole rigmarole like you're talking with your Reg A. Okay.
That's exactly right. Otherwise, you have to be licensed. Like I didn't know I had to be licensed to raise money in Colorado until I got the invite, right?
Oh,
once the invite was there, I'm like, oh. Okay.
So for like a Reg D, would you have to be licensed to raise the money? Or no, not at all? Okay.
No.
Because there are state-specific regulations probably too, I would imagine.
Yeah, every state, even on the Reg A, surprisingly, like Texas, for example, which is the most pro-business state that I know of, requires you to sell your security through a broker-dealer.
Oh, wow.
So even though I have a Reg A, fully approved Reg A, I still have to hire a broker-dealer to advertise and bring in money from Texas. So every state's different, and they're more strict on the Reg D side. But if you're just bringing money in for your own deals, or you're brokering private money notes and you don't have a license, I think every state's going to have a problem with that.
Yeah. It's funny. You say Texas being the most, one of the most business friendly states. I mean, the reason that exists is because there's a whole group of people that make a killing being that middle person. Right. And so that's the pro business that they have. There's some sort of lobby that like has that portion of it. We're not giving that up. You absolutely have to go through us so we can get our piece of the pie of everything that's raised here.
Yeah. So they want you to be licensed. But when the attorney said, don't raise money from these specific states, and I saw Texas on there, I about fell out of my chair.
Yeah.
Like that's the one that I thought didn't care.
Right.
Yeah. No, that's interesting. So that's cool. So as you built that out, what does your lending business look like now? I have on my notes here. You have multiple mortgage funds and you're approaching $1 billion in fundings. Yeah. Like that is a lot. So like what is your whole system set up like now with all that?
Yeah, and we're really growing now. We're refocused. I went through a divorce about 7 years ago, and I just like, I'm making money now. I don't need to grow the company. So I went through a lull, but now we're starting to see some pretty impressive growth. We're about 140 million in assets under management right now. We have 4 mortgage funds. We're loaning pretty regularly in 4 different markets. I'll go national on the commercial side, but for the fix and flip and type stuff, we're very geographically focused. And we'll do 200 or, our goal for this year, 225 loans to close and another 140 million bucks. My guess is we probably beat that.
Wow. Nice.
We have a small office, 13 people.
Sweet. And those are, I guess, so what sort of like rates and stuff, I guess, do you normally advertise? Because that's sort of the big thing that everyone's looking at with hard money loan and, DSCR private money lenders is you can go and talk to 10 different companies right now and get things that are so wildly different based off of what their back end fund structure looks like.
That's exactly right. DSCR is a funny product because it's very institutional. Right. Nobody's holding that on their balance sheet. No private lender's holding that. It's all going off into Wall Street or or actually it all is basically. So that you shouldn't see too much variance in that product, but the private lending side, like the fix and flip, it's all over the place because a lot of the lenders hold it on their books, right? We charge typically it's 2 points, 12% interest, which used to be on the high end. We kick everyone's ass in service. We don't compete on pricing. And do you want a steak or do you want a McDonald's? So that's kind of how we looked at it. But now we're holding firm on our prices and everybody else is coming up. So we're pretty close in there and shit, we'd like to lower our prices. So we're working hard to bring our cost of capital down.
Nice. And that's 2 and 12 for a year and 10% down on loan to cost, I would expect.
Yeah. So we still do the 100% financing. So we're 100% loan to cost, 70% loan to repaired value.
Okay.
Or stabilized value.
Yeah.
So we're ultra focused on that end value and less concerned on what it's going to cost you. If you could find a great deal, we're in it with you.
Right.
Normally it's a 9-month loan. We really, we want in and out of these. That helps reduce market risks. But we'll go longer if it's like new construction or it's a pretty massive rehab. We can go a little longer.
Nice. Yeah, that's huge. At that 100% financing, I mean, that alone warrants the extra cost from some of these other companies that'll be like 10 and 3, but you have to bring, sometimes significant money down. And this is something that Dan and we've gotten so frustrated as we've done our flips and our acquisitions over the last couple of years, is like, we'll get quoted something and then it's almost like a sketchy wholesaler trying to change the deal on you the day before closing. Like, will literally be the day before funding, and they're like, "Yeah, you actually have to bring an extra $35,000 down now, just because I hate you."
Yeah, you'll get the disclosure, and you're like, "What are these $8,000 in fees that just showed up?" And then you call them like, "Oh yeah, that was a mistake. We got to take those off." Yeah, right.
They just want to see if you can see it. Oh,
yeah, exactly. Yeah, we've had that we've had several issues with certain people. Certain lenders.
Yeah. So it's interesting.
We're pretty transparent. We don't play those games like you see 1 in 7.9%, and then you call them. It's like, oh, we're going to add on a little bit for this and this and this, like adjust risk adjusted rates, right? And then all of a sudden you're at 2 and 12.
Right. Exactly. Right. Yeah. Exactly. No, that's cool though. I like that you're doing that. And then what markets are you guys in? Like, do you do
we're in Colorado, up and down the Front Range.
Okay.
We do a ton of business out in the cities, Twin Cities and Minnesota. We're at Milwaukee, and we're starting to build some traction out in Washington, D.C.
Oh, nice. Wow. All over the place.
I know, but each one has its own story. But we're hyper focused on the markets that we're in.
Nice. Okay. Sweet. So let's talk creative financing from a lender's perspective. As that is always the biggest thing that comes up with creative finance, is like, how do you get around things like the due on sales clause, or do some of these wraps and all that sort of stuff. So I guess from your experience as a lender, with your lending knowledge, I guess, what is the correct way to approach a lot of these seller financing? No, it's not like seller financing, these creative deals, when there's like a loan in place, or like from a lender's perspective, like, how do you feel about them? I said, you said you agree with them, but like, what are the appropriate tactics people should take with these?
Okay, so you got to remember, I'm a private lender. I'm not like loaning out bank money, right? So I'm very much more on the investor side when it comes to this stuff. Now, I have a due on sell clause in my loans too, and if I find out that a mortgage or a property changed hands, I'll definitely give them a call and try to find out the story. I at least want that. But gosh, if that loan's current, why would I call that due?
Exactly. Right.
And that could change if it's small banks and they were loaning out at 3 and now they're 7 or 8. I could see like a little tiny bank or something wanting to call those due, but it's so rare to see a due on sell clause called if the loan is current. When I was working on the Wall Street as a bond analyst, what I learned was every foreclosure that the bank takes, first of all, they get judged and graded on that, right? Because it's not the Wells Fargos and the Chases that own the loan. They sell it to Fannie and Freddie. They're just servicing it. So as a servicer, they get graded, and they're rated. So they don't want defaults. So you're telling me you're going to move a current loan. It's in the current bucket, which makes you look really good and smart. And then you're going to move it all the way past all the 30, 60, 90-day buckets, all the way over to the foreclosure bucket because it changed hands. You're just not going to see that.
Yeah. Yeah. And I think that's always the mindset people sort of have too, is if it's current, no one's going to find out, but there's always that underlying factor. And what you said there too has been the biggest thing that I've cautioned people on, especially as you see all these people that are out there like, oh yeah, just go and inherit these like 2.125% mortgages and, just like pay it and no one will find out. But like, tell you what, like Wells Fargo or some of these people, they can lend it out at like 8% now, 7%. And they find out that it violated that contract that they had with the original person at like, 2%. They're absolutely going to pursue that. For them, that's billions of dollars in difference across like their entire portfolio.
I would argue the opposite point though, because the cost of doing so, that you could be potentially taking back a house on a note that is worth the same as the note, and now you're going to add all the costs that you have to go to resell it. So I think there's I think you're a very valid point there, but I also think there's a good argument why they wouldn't do that.
Yeah, I would actually lean more towards you, Dan. I think where I was going is when I was analyzing those bonds, the average loss is 50%. It's almost 50%.
That's crazy. That's so much.
It's crazy because borrowers people are smart. They could extend that foreclosure out. Just file bankruptcy.
Yeah.
It's going to slow you way down. I'm going to stop making payments and I'm going to file bankruptcy.
Yep.
Yeah, that's been the go-to. We know several people that have done that this year.
Right. I do think I lean towards what you're saying, Mike. If it's a local small institution that knows their market, they know what's on their balance sheet, and they have a very specific relationship, and they're like, hey, I know what's happening. We can make some money here. And that person has potentially promotions, up, for doing stuff like that. I don't know. But like for the big Wells Fargo bank, like people don't go to work to do their jobs in big corporations. They go to work to do the bare minimum.
I guess that's true for like the Wells Fargo example, but like look at the deal that we're dealing with right now. So we have a deal that when we bought the property, we told the lender, hey, our plan is to fix up this property and keep it as a rental. It's an oversized lot. We're going to segment off the back of the lot and we're going to sell it. This was, early 2021. And they were like, was it early 2021? Late 2021. They're like, cool, that's fine. No worries. We'll do that. Went like 3.5% rate, blah, blah, blah. Went through the whole process, segmented off the lot. We got it under contract to sell. And we're like, hey, cool. So you remember what we talked about? We need a partial reconveyance. And they're like, nah, we're not letting you do that now unless you refinance your loan. You increase your rate to 8.5%. You pay your 5% early payoff penalty. It's a step down, right? And they're like, we're not going to let you do it anymore. And that was
they weren't going to let us do it from the beginning, though, let's be honest.
I know, probably, yeah. They
just said that because they wanted to sell you the loan, right? You know what I mean?
Yeah, that's probably
some of these people. Anyhow.
So what do you do? Sell it for a contract for deed until that 5% goes away, and then have them.
Well, we really can't do anything because in our county we can't record the new APN until we get partial reconveyance. They won't recognize it as because there's a lien against it still. So we have to we have it. We have 2 lots. The city's just like, nah, not quite yet.
Yep. So we just got to sit on it.
We got to sit on we could do it and we'd still profit quite a bit, but it's like, we don't need to. That's why we're kind of sitting on it.
Yeah. We basically would pay like $20,000 in fees and lose our cash flow on the rental. Yeah. And, even though we'd make like $160,000 on the lot, we might as well just hold on to it because it's in like the best part of town. Like it's still going to be worth good money in a few years. So don't worry about it.
Be worth more.
But that was supposed to be my vacation fund this year.
That's I know that was big money. Big money, dog.
Yeah. So anyway, but no, so that's good. So I guess for people that are interested into getting into lending, can I give them, what would you tell them is a good place to start? Because obviously everyone thinks like, well, I need money to lend, right? Mm-hmm. You can go raise money like you have. What's like step 1 for people?
Learn the business. I mean, you could be really, really safe and probably never lose money at all. Mm-hmm. Or you could lose everything. Mm-hmm. It's not like an in-between like you would get if you were an operator or you owned the property. I'll give you an example. We had there's a big national team that goes out there, and they were on TV and they were getting a lot of people into their program. And so they would have like a $40,000 program, and you go for a weekend boot camp, and then you have coaching for after that, right? Well, they're teaching people to gap fund everything. Mm-hmm. So for you that don't know, gap funding is, okay, I'll use my hard money up to max out my hard money loan. And then anything else that I need, I'll bring in another private lender to fund all of that so that it's no money down for me, but it may or may not be a great deal because the hard money lender didn't fund the entire thing. Right. So I'm going to gap fund this. I'm going to get my uncle or my aunt or my friend or someone to do that. They're going to go to a junior position, so they're nice and safe. But here's the problem. You don't have any collateral.
Nothing.
If you're not strong enough to pay off that first loan through a foreclosure, you don't have any collateral at all. 0. So that second doesn't mean shit. Right. And then what happens is they default on me or another hard money lender, and we have to foreclose to protect our money. And they just get any juniors behind us. If they don't pay us off, they just get wiped off the title. We had someone lose $80,000 in her retirement account, her entire retirement. Mm-hmm. It's sad for me to even sit here and tell you this, but what am I supposed to do? My fiduciary responsibility is to my investors, and I just wiped out this $80,000 loan.
Well, ultimately, you shouldn't feel bad, honestly, because it's not your responsibility. It is the responsibility of the person that, swindled their grandma into taking, using their IRA to do that.
It's terrible, though. Don't you think, Mike, that's like ruined her retirement?
It's absolutely horrible. And the thing that really upsets me is this is such a plague right now amongst the real estate investment sphere with all the influencers. I can't scroll through a single thing on Instagram without having some dude with like a snapback hat that's like, this is how I got rich using OPM, other people's money. And it's like, you just go find your grandma in Florida, teach her how to get a HELOC, and then have her wire you all of that. And you can just go and do shit. Like, it's so dumb.
It's scary. It's really scary. So I wrote a report for people that want to get into private lending, not self-serving. I really don't want the $80,000 loss.
Yeah.
So, I mean, I could give that report to your listeners for free.
That'd be great.
That'd be great. Yeah, absolutely.
I'd love to read it too.
Yeah, absolutely.
I'd probably learn something.
But learn the business, I think, is huge. And then I would say from our perspective, so we do a little bit of lending, is talk to other people that are in the business and sort of like listen to the things that they have to say. Because here's the thing that as well, I used to work for a hard money lender, and everyone's in business to make money, but ultimately the goal of a lender is to not lose money, like at the end of it.
Absolutely. That's worst case scenario.
Yeah. And that's what my boss told me at the company I used to work for. He's like, we were going to make good money here. It's a hard money business. We get good returns, but ultimately if we lose money, we are failing. And it's not just about growth. So you need to have that view when you're making these educations as a lender. You're looking to lend money or you're looking to do anything like that.
Yeah, and you can make a ton of money in lending too and be really safe, right? But if you're doing it on your own, you could charge the 2, 3, whatever points in fees plus the high interest rate. If you want to work with a professional that knows what they're doing, maybe you have to give up the points or a spread on the rate or whatever it is because they need to be compensated also. But now that you have someone that knows what they're doing.
Right.
Yeah. Exactly. Yeah. So awesome. Well, good stuff, Kevin. All right. So we're going to roll into the end of the show here. We always have our end of show questions that we like to ask everybody. First one is always the favorite question. I'm guessing you probably have a few since you've been in this game for a long time, but what is your craziest real estate investing story? And this can be a big win, a big loss, a crazy tenant or seller, anything in between.
The one that's coming to my mind immediately, Mike, is my very first deal, the one that I moved out of and rented out. So I rented it out to, I think, a gang. I didn't even know it.
Dude,
I pretty much did.
No, so nonchalantly. Just the Crips. They're good.
What are those gangs in South Denver?
So it's funny. So I'll back up. When I first bought the house, it was all I could afford. I was in Denver is actually not that. I mean, it's a pretty safe city for the most part, but there's little pockets here and there. And I was in the worst pocket of them all. Like the helicopters would fly around with the spotlights every once in a while and that kind of thing. When I first got there, the gang members welcomed me to the neighborhood by letting me know who they were. So I got spray paint all over my house when I first bought that. So when I moved out of it, I rented it out. I didn't do any screening on this tenant. I got an application, but I didn't pull credit or I didn't do anything. They lived there for a little while and I had to evict them. So my very first rental property, my very first tenant was my very first eviction. And this is actually pretty rare. Usually you don't go all the way through an eviction process to where you're pulling their shit out of the house. Normally, when it starts getting close to that, they just move out. And I learned that later. This time it went all the way to the sheriff, and I had to get my friends. I couldn't afford a moving company or anything. So my friends, I took off of school. My dad took off of work. I had my sister, some of my buddies, and we all went over there and to take all of her stuff out. What was funny about this one is they ran an extension cord from the house into the shed because someone moved into the damn shed.
Oh my goodness.
So now we have someone living in the shed. We had to evict the shed. As I'm pulling this stuff out, it was like, I don't know, 40 or 50 car stereos. Oh my God. I think they were operating a business out of the shed as well.
Oh yeah. Successful
black
audio
business. Anyways, got them out. They left a car there. I called my next door neighbor who has some connections in Mexico. He got rid of the car for me. I have no idea where that went. And I got my property back. 2 days later, they broke back in because apparently they had a bunch of illegal firearms in the attic. So is that a crazy enough one for you?
I'm laughing at your misery.
That's pretty good.
So calmly.
Yeah, right.
Yeah, and I stayed in the business. People ask me sometimes, how in the hell did you survive that?
Oh, man.
But yeah, here I am.
You did.
Did you have any future issues with that property after that? Because it was on the gang member's radar. I mean,
Yeah, no, because I made friends with the neighbor, and he kind of ran the neighborhood.
Oh.
So him and I would drink beer together, listen to rap music together.
So you're good. You're in like Flynn.
Yeah. So it was basically like, you see in movies, there's like the convenience store that's protected by the mafia. You basically had that for like your first rental.
It felt like that. It really did feel like his name was Ricky. He was awesome. He didn't like me at first, but once I invited him over and had a beer with him on my patio, he was like, "Dude, you're cool."
Yeah, he's like, you're good, man. Yeah. That's awesome.
You tell me if anybody messes with you, he said.
Yeah, right. Yeah, that's a good one. That's super funny. Cool. I'm glad you got through that too, and you didn't have any like actual confrontations, because we've had a couple stories that are kind of similar, and like, gang members will like show up to like interfere, and that's a whole other situation. Yeah. But no, that is a crazy one. All right. Second question is, what is the number one tip you would give to either a new investor looking to get started or to a small time investor looking to take their business to the next level?
Yeah, I think this is going to go for every investor. You really got to get control of your subconscious mind. So especially for the newer folks, but your mind will limit you on what you're going to accomplish. And if you want to break through that and really grow, you need to figure out how to remove that ceiling. And your subconscious mind does that. So I'm thinking like, what's the one thing that prevents people from what their potential is? And it's fear. It always comes down to fear. I'm not going to do this action item to reach this goal because I'm scared of it. Right. So how can we get past that fear? And I would say just start reading and understanding how to control your subconscious, and you can beat that fear.
Yeah. I think that's huge. And I think that's such a core thing that most people don't even realize. Like we talk to a lot of people, especially if they're not like entrepreneurs, and they will blame things like, time or like laziness or, bad habits or all that sort of stuff. But at the very, very root of it, it's because you are afraid of fear of either the outcome, you're afraid of the fear of the work, you're afraid of the fear of the discomfort of, whichever you're going to put yourself in. And I think
it's failure.
That's great.
You're afraid to fail.
Fear of failure.
Look, everybody fails. I say it all the time. You're afraid of failure. You're failing now.
Yeah.
Like, you're going to fail. Let's stop being afraid of it and let's embrace it.
Well, everybody has fear, right? I think everybody does, unless you're a sociopath. Like there's some level of fear, you just have to overcome it. And Pat Hyven and Tim Rode in the book Quitter's Manifesto talk about that, like as a cliff, like talking about like leaving your job and like going for what you're passionate about. And it's like, sure, there's probably a bridge somewhere, but it doesn't go to the same place. Like you can cross that cliff, that, get to the other side, but it's just not the same place, because that bridge, it's like anything in life. If there's no risk, there's not the same reward.
Yeah, I love it. I haven't heard that, but I love that.
Yeah, well said, Dan. Perfect. All right, last question. Where can people find you, follow you, and reach out to you if you'd like them to do so?
Yeah, so that report I was talking about, there's actually 2 reports on this website. It's thepinereport.com. I compared the 1990 crash to what we're going through right now in one of them. I think that the 90 crash with the savings and loan crisis and the high interest rates and high inflation much more resembles what we're going through right now than 2008. Everyone tries to compare 2008 to today, but they're totally different. Right. It's not even remotely close. Today we're going into a recession because the government is forcing us into a recession. In 2008, greed forced us into the recession. So how do you compare those two? So that report and how to stay safe as a private lender, you can find that at thepinereport.com. You can reach out to me if you like. You can find me at pinefinancialgroup.com. And then, I guess that's the best way to reach me.
That's perfect. Cool. That's great. Yeah, I'm definitely gonna check out that report, because you're the first person that's talked about the 90s financial crash. Everyone always talks about 2008. No one even talks about the 90s crash, which is, just as relevant as all the other ones.
But, well, how do you compare 8 to now? It doesn't.
It's like generals. They always say generals are always trying to fight the last war, but that last immediate war is not the tactics you're fighting this war. So I love how you're talking about going back to the 90s to something that's actually resembling what's happening.
Yeah,
that's cool. I'm definitely going to read that.
Cool. Yeah, definitely check it out. So awesome, guys. Well, thanks so much for listening. And Kevin, thanks so much for coming on the show, man. It was great to meet you, and super insightful stuff on like the lending side that we don't get a ton of on here. So I really appreciate you taking the time. So anyway, guys, go check out those reports from Kevin. We will put all the links in the show notes. On top of that, please share this podcast with anyone who is interested in lending, real estate, business, or anything in between. It's the greatest way for us to grow the show is if you share it with your friends. And I'm sure you know at least one person that's interested. So challenge is go and share it with at least one person who would want to learn about how to make their lives and their financial pictures a little bit better. On top of that, if you want to start learning how to generate off-market leads, go to collectingkeyspodcast.com/free. You can get our free 5-step guide for generating off-market leads, and that will get you started getting into positions where you can use services like Kevin's lending business to go and buy properties and, make some big money for yourself.
Make some cash.
Anyways, guys, make some cash. Thanks so much for listening, everybody, and talk to y'all next week.
See ya.